Joining us right now is Spruce Point Capital Management founder and chief investment officer Ben Axler. And Ben, it's good to see you this morning. Thanks very much for joining us.
Thank you for having me.
Were you surprised at that big rally in stocks yesterday?
Not at all. I think the market's base case was that the Democrats were going to take the House. Obviously, political uncertainty is never good for markets. Markets got what they want. Now we move on to the Fed and the interest rate.
So what would you do in terms of money right now? You want to put money into work in stocks or no?
So we're a short selling firm. We play defense a lot. We think right now it's not a great time to be overly exposed to stocks, given where we are in the business cycle, rate rising cycle. We're in a lax regulatory environment as well. We're focused really on companies that are flattering their numbers with aggressive counting, receiving high valuations for speculative business models. So,
and just to be clear, you're shorting those companies.
Absolutely.
Yeah,
we're shorting them with an activist bent. We put our research on our website and try to find, the good companies from the bad companies.
On the politics side, do you think the markets sort of like divided government, where, you have the tax cuts, you have the deregulation, things are doing very well in the economy, so maybe some gridlock is sort of okay in Washington?
That seems to always be the case. Yeah, I mean, historically speaking, gridlock is somewhat bullish for markets. But we're really focused more on the rate rising cycle and think that the market's going to be more discriminating now. The easy money is made in a lower rate cutting environment. Rate rising cycle, the market focused on the quality of the companies, the valuations, and how the companies are putting the capital to work.
What about the tech sector? That the big tech companies took a bit of a beating in the last month or so. Had some good, a bit of a recovery yesterday. I'm interested in your point about companies that are maybe have got some questionable numbers. Where do you see now, because they've been so much behind the the surge in equity prices in the last couple of years, and they now dominate the index, many of the major indexes. Where do you see where do you see the major tech companies going in the next year or so?
Yeah, so we had some really good success shorting tech companies this past month. Yeah. The market is much more discriminating now on the quality of the business. So one of our best shorts was a company called 2U. It trades at 10 times revenues, losing $40 million a year. The stock was at an all-time high. Brokers putting a $100 price target on it. Now the stock's at 50. So it really comes down now to the quality of the business. Are they making money? Do they have a path to profitability? And I think you're going to see more discrimination between those that have a real business model and those that don't.
And rates, you see, we're going to see the Fed today. The Fed's not going to do anything today, but short-term rates have gone up. We're seeing long-term rates have gone up as well over the last year. How much is that starting? I mean, obviously that's having an overall effect on the market, but how does that affect some of the individual companies that you're looking at? How do you weigh that as you look at?
Tremendously. So we've had good success in the past month, shorting companies with low organic or declining organic growth and a lot of debt, particularly companies exposed to short-term debt. We recently shorted a company called Dollarama in Canada. $1.8 billion of debt coming due in the next 24 months. The market is discounting. The companies are going to have to refinance. They're going to have to refinance at a higher rate. And the market's discriminating between those with longer-term weighted average maturities and those with shorter.
Are you short Tesla?
We're not short Tesla. We try to find companies that have a less crowded short position. As we've seen, Tesla's a battleground stock, can move 10, 15, 20% on a tweet from Elon Musk. We're trying to find situations where the market doesn't already know what the short thesis is, less crowding, lower short squeeze risk.
What are some other shorts that are too crowded for you to really want to anticipate?
Well, I mean,
participate, rather.
Yeah, I mean, our threshold generally is if we see a short interest higher than 30%, that's sort of indication to us that, hey, the market already sees that there's a structural problem here. When the interest, when the short interest is that high, sometimes the cost of borrowing the stock is high. So we're trying to find situations that aren't crowded where we're actually getting paid right now to short, given the general collateral rates of 1%, Those are the situations we want to be involved in.
What's the best short you've done in the last few months?
So we shorted Maxar Technologies. This was a merger between McDonald Detweiler and Digital Globe. We shorted it in the 50s. The stock went down to about $15 a share. They just impaired their satellite assets. A lot of debt, no growth. The market's figuring these situations out quickly.
So what's your take on the broader market? I know you have specific, shorts in some of the smaller companies that are unknown, but your take on the broader market. We had a huge rally yesterday, bit of a pullback this morning.
My take is that we're in the later stages of cycle. I think the market can continue to grind a little bit higher. We've been pretty vocal that we think we're in a sort of low single-digit return environment with a lot of volatility. Volatility presents trading opportunities, clearly, but investors need to play defense. not every stock's a buy. A tremendous amount of the brokers are still putting buy targets and 20% upside scenarios on stocks. Investors need to scrutinize their portfolio carefully, play defense, but they can still make money on the long side. It's just going to be a little harder.
All right, we will leave it there. Ben, it's good to have you. Thanks so much.
Thank you.
Ben Axler joining us.